Today's focus is Peter Lynch and the Fidelity process versus Elon Musk and the Tesla process is what we're focused on today relative to Tesla's stock price behavior over the last couple of weeks, but really over the last 6 months. We want to first thank our Patreon supporters as well as our subscribers. If you enjoy the show and like more and better analysis on investing and trading Tesla better, please join us on Patreon. I think you'll find that at the top tier, we have daily shows that are helpful in the process of commanding a whole bunch of information that'll be helpful and productive in your investing trading process. So we sort of took some time away for a few days to really do some deep dive into the research associated with, well, what's going on with Tesla and why aren't we getting the nice bumps in prices that we were last year on similar information? We've definitely seen a change of things since the S&P changeover, but there seem to be some more significant structural changes that have affected what the stock is doing on a daily basis, weekly basis, etc. So as I was going through my research process again, we actually have a listing, if you look below, for a guy named Peter Lynch. Peter, as you know, was Fidelity Magellan's former manager. He's considered on par with Warren Buffett or any of the other major investors over the last 50 years. And he built Fidelity Magellan from very small to one of the largest funds in the world based on process and the success that he's enjoyed. We recommend Beating the Street or One Up on Wall Street, both books sort of updated one to the other, but we also recommend all of the podcasts that he has on. And the beauty of his work is that it doesn't take a finance expert to understand it. So I would even recommend it to kids as young as 10 or 15 because the basics are so excellent. One quick example would be I have an uncle that I recently visited, and he's somewhat of a novice investor and was introduced to some investing ideas by someone, and he bought some stock in a kind of a somewhat of a startup, I believe. And I recommended that he trim his position and follow an idea that Peter Lynch presented, which is he's in his 70s. So John Bogle suggests that when you look at your portfolio, the decade you're in should be a corollary to the percentage of bonds that you own. So therefore, if you're 70% bonds, et cetera, 60% bonds, a John Bogle suggestion, not a Peter Lynch one, but I think an excellent one. So in this case, what I recommended to him was, following Peter Lynch's guidance, I suggested he consider going to his cabinet in the bathroom and looking at what medications he takes regularly, and then looking at purchasing shares in those companies, because if he's already spending money with them in a form of the medications, it's an excellent place to store stock or stock to own because of the dividend being a reflection of him doing the basic research on that subject because he's taking the drug naturally. So I mentioned this to him. I don't know if he followed through on it, but it's some of the great advice that I've gotten from Peter Lynch over the years. And this is the first in what will be 2 Peter Lynch shows. We have another show that we're developing based on his research and work that you'll be receiving end of the coming week. So one of the things that we identified with Peter Lynch's research and what's going on with Tesla is that there's kind of a clash going on between different philosophies right now, and that clash is affecting Tesla's stock price, is our assessment of things. So an example of how things work, and I think you'll notice this, is take a look at Apple stock. Yes, it's been up nicely, but the other thing I've noticed about Apple versus Tesla is that when there are market downturns, the tendency is for Apple to hold up pretty well, if not rise, while Tesla is actually falling. And so this is one of the byproducts of the process difference, I believe, between Tesla and what's going on with Apple or Google or some of the other companies. So the first part of what we want to cover today is a whole idea called, there's a general field of investing called value investing. So the idea behind value investing can be illustrated somewhat in a simple fashion to say, the way you get a stock price is you take the current earnings and you multiply it by the growth rate. And so that gives you a number. So for example, if a company earns $1 per share and it's growing at 100% per year, you multiply 1 times 100, and that equals a $100 stock price. Same idea, if you have $100 that they're earning and they're growing at 100%, you sort of do the math, and that's what your stock price ends up becoming. So I wanted to introduce this to you because this basic level of value investing is what the money managers around the world of all the big firms are taught very carefully as they come through their analyst program. In fact, for our Patreon supporters, you'll be getting a copy of all the books that are required reading for the analysts at one of the largest firms in the world, because he's a friend of mine and he sent it to me, and I think you'll find it useful in your developing your own investing skills by having that information. So, as you know, I'm doing a second round today to get our sound right, and so that's what we're doing. So, to follow on this theme of, well, just take the earnings and multiply it by the growth rate. Well, there's something fishy going on here. So when you're looking at Google or Apple or some of these other companies who actually know what their earnings are, in the case of Tesla, in this case, there's some challenges. Elon has a process going where you get to see the revenue because you know how many cars were sold / how much work they were doing in other areas like large solar projects for people like Apple and others. The problem, though, is that the question is, well, what are the earnings? Well, an example of the problem is I had a conversation last week with an executive that's affiliated with Tesla. And one of the things he pointed out to us was he said, well, look, don't worry about the Bitcoin situation and potential impairment because we have so many dollars that are coming in from the EV tax credits around the world that we can sort of whip out that cash anytime we want to kind of fill holes if there might have been somewhat of a loss associated with that decision. So I was like, wow, that's impressive that Tesla has that much cash sitting on the balance sheet that they can bring to the rescue. So what investment managers at the largest firms are taught and sort of required to do is identify recurring revenue, both profit and earnings, and profit being same as earnings, but revenue and profit, you need to have, a hockey stick up, in essence, going on. And the fact that this company can both keep growing earnings and profit at a predictable process allows managers to sleep well at night. When you go to unpredictable process, you now end up in a situation where then when they start to guess at what the real numbers are, that's when they don't sleep well at night, and they do a process that's called discounting. So instead of getting a market multiple consistent with your growth rate, you get a discount because they're not quite sure, are you going to generate the profit necessary to validate the stock price? So we got to give you a discount. And I feel as though right now what's happening with Tesla is they're getting a discount against what their real growth of profit and revenue is. Why is Elon doing this? Excellent question. I knew you would ask. The reason is simple. Every $1,000 to $1,500 reduction in the price of the vehicle allows Tesla to sell more cars. So I believe that Elon's decision to use EV tax credits to bolster earnings allows him to lower the price that he would normally charge for the car, making it even more competitive and more compelling for potential buyers. Now, I think this is a good idea, but clearly one of the reasons why there's such a broad range of estimates for Tesla's stock price, anywhere from $150 from Gordon Johnson all the way up to $1,200 from ARK and others, is that you have all these money managers that are trained along a certain line. And when someone does something else different, unless it's sanctioned by the giant firms, if you will, you end up with this discount, and therefore things work differently. So one of the arguments you can definitely make that's happened to Tesla after or during the S&P process is a transition to a very large percentage of the shares held by institutions of different types. So there's a niche in the investing world called big cap growth, stands for big capitalization growth. So what a lot of money managers around the world love to spend their investment dollars on is exactly these kind of companies. They are Apple, they are the Googles of the world, etc. They want the growth piece because you know they're going to have good earnings, and you also get a growth in the value of the stock. They also, so there's a myriad of reasons, but probably there's a group of 4 or 5. The second group of reasons is big cap. Whenever you're dealing with a company, let's say $2 trillion, $3 trillion like Apple, and it's growing, you want to be in that stock because there's a famous line that says nobody ever got fired by buying IBM. Well, guess what? All these money managers have learned which are the key stocks in the field that they should be purchasing. And if they choose not to, they could jeopardize their careers. And so you tend to find folks piling into the best names, Apple, Google, Amazon, Microsoft, all these sort of big companies that are famous, growing great, etc. So what we now have is a situation where the question is, with what Elon is doing, what are their real earnings? I believe the reality is Tesla could increase the price of every vehicle by $1,000 and still have no problem selling almost the same number of vehicles. Elon hasn't chosen to go that route, and that is somewhat hurting the company in terms of confidence from the money managers, where they're saying, well, we know you could increase the prices and still sell most of the vehicles you're currently selling, but the fact that you're doing that in this way suggests to us that we need to discount you slightly because this introduces a risk for you as a big capital firm that we don't have to deal with other firms of similar nature. So we'll see how this all plays out. I think that what it looks like is going to happen is the growth associated with the new factory, both in Austin and Germany, as those vehicles come on and we have increased sales and growth from both Fremont and China, you'll see the numbers, the revenue growth being strong enough that people will start to allow the stock to rise to a higher number. So the problem you have is, I actually took some time to go back because what I think we all should know, and I'm encouraging you as a friend to know this as well, is you should be able to tell me what the stock price should be based on Tesla's growth rate. And so if you look, the backwards number is 143. So if you go back over the last year, based on the earnings Tesla's reporting, the run rate is 143. 143, if you will, percent times the earnings Tesla is equal to the stock price. If you go forward a year, you're looking at a 160. So those are very high numbers, and there's a whole bunch of things that happen with the numbers being that high, but the biggest problem that's lurking is without a clear sense of a confident number that the money managers can work from, you have this, well, we don't know what's going on, we'll discount it even though the company's growing great and everything is going fine because this is risky. The other reason why it's being discounted and affects what happens with the analysts is, if you think about it, the idea of recurring revenue. So yes, they have the EV tax credits, yes, they can report them as earnings, but as more of those manufacturers start producing their own vehicles, those EV tax credits are going to go away. Now what happens? And this is why we have a discount of Tesla's stock price, as we have more professional money managers and fewer hedge funds that are control/owning the stock. So I think that the result of all of this is that Tesla's earnings end up trailing what its actual growth rate is. And that trailing process actually is why we're not seeing the really nice moves in the stock price surrounded by, an obvious 100% growth in vehicle sales in 1 year, or, based on last year into this year, and then all the other big numbers that'll come from adding more production over the next couple of years. So I do think that we're in a period of difficulty for Tesla, where even if we have good revenue numbers, we still have this profit unknown number that causes people to be able to put narratives out there reflective of these numbers, not sort of fitting exactly what the money managers want to see, that represents a long-term recurring revenue, recurring profit percentage process. So, I really think that there are a lot of elements to how Tesla's earnings, the way they're reporting, are hitting things because, for example, as the executive said to me, look, if we have any problems not meeting our profit margin, 23.5%, all we have to do is simply increase the amount of EV tax credits we use, and we can sort of play around with what the margin is that we're getting per vehicle, and therefore the earnings we're getting. So this sort of unknown zone in my mind, when you switch to most of the owners of the shares being large institutions that have to justify everything and benchmark it against competitors, clients, or other funds within their firms, you now have this little challenge going on. And I don't see it significantly changing for quite a while until we have, giant new catalysts like a new factory or a known date for that new factory. And now the associated revenue/profit can sort of be rolled out from it. So, I hope this has been clear. We always look forward to constructive criticism. As you can see, we have capabilities with sound that we'll be working on hard to make sure we get it right, and appreciate your input on this. Also wanted to remind you, we do have some SpaceX shares. If there's interest, hit us up on Facebook in a private message. Also wanted to note to you that, please like and subscribe and join us on Patreon to get more information that'll be helpful in your investing process. I have to say, we didn't do as many shows this week as we usually do because I've been very, very disappointed in seeing Tesla's stock price not able to break out into new highs based on generally good information. I really believe the logic of what we've presented sort of explains where we are currently and why we're not in the breakout situation we should be positively for Tesla. But I just think that the operations are solid. The other benefit of you being a Tesla owner or almost owner of a vehicle is that you're doing a lot of fundamental research. All of your experience of car ownership and et cetera, and the people you talk with about it, et cetera, represents branding and marketing for Tesla that helps the company do better over time. So I just want to suggest that you can invest in it better than others because you have a better command of the capability of the vehicle, goods and bads, and therefore, as an owner, you represent another reason for other people around you to consider buying the vehicle. So, we look forward to continue following this theme over time. We appreciate your taking time to join us. This is Greg for Teslafaninsight. Just remember, prior to lovemaking, no more than a light salad to allow you to have all the blood flow, not go to your stomach and be available for other extremities. I want to highly recommend you look up something called core training because as you age, I think you'll be impressed by how it helps with back pain, et cetera. I found it to be phenomenal and working great for me, and it doesn't involve taking drugs to feel better if you have a little bit of back pain going on. We also want to encourage you to take a look at our list below. We have a number of recommendations from different physicians of things to consider in terms of managing your health better, because I think you'll be happier with it over time. The one last thing, again, we've already covered this before, but One of our doctor advisors just shared that he quickly got both vaccines when ready because he believes that the way drug development works now can be a lot faster but still effective, and that it's a good idea to take it because he believes that it's safe, and that others should consider the fact that we have better process, in this case mRNA pops to mind, but better process in rapid drug development that can be safe and therefore and effective. Therefore, it's a good idea, especially with things like this Delta moving in. At any rate, again, want to thank you for joining us. This is Greg for Teslafaninsight. Tschüss, German, au revoir, French, Lehit Hebrew, Choda Hafez, Farsi, Zdravstvuyte, Russian, Ni Hao Ma, Chinese, Konbanwa, Japanese, Namaste, Hindi, Hey Do, Swedish, Good day, our friends in Australia. And in Jamaica, we say, Nuff respect, walk good man. Thanks for joining us. Have a great day. Bye for now. We look forward to your constructive comments.